You have probably seen people talking about rising bond yields, saying the bond market is giving us a signal. So if you mainly invest in stocks, you may be thinking, why should I even care about bonds? Because bond yields affect interest rates, government borrowing, companies borrowing, mortgages, and eventually stock prices. So starting with what a bond is. A bond works almost like a fixed deposit. So let's say you lend $100 to the government. It promises to pay you $6 every year. And after 5 years, it gives your original $100 back. That $6 is called the coupon. It is that simple. Unlike a normal fixed deposit, bonds can be bought and sold in the market. So imagine the same $100 is now available for $95. So you still receive $6 every year and you still receive $100 when it matures. Because you only paid $95, your actual return is higher. That return is what people normally mean when they talk about bond yield, which gives you one rule worth knowing. When bond prices go down, yields go up. When bond prices go up, yield prices go down. So why rising yield matters to you? So if inflation stays high, investors usually want a higher return for lending their money. Why would I lock my money into a bond paying 3% if it cannot even beat the inflation? Or if bonds are paying much more, older bonds become less attractive, their prices can fall and their yields rise. So higher yield means borrowing money becomes more expensive, and that matters because government, companies and regular people all borrow money. Government have to pay more interest. Take the example of United States. The government spends more money than it collects in taxes. So it regularly borrows by issuing treasury bonds, and it also has old debt that matures and need to be replaced with new debt. So when interest rates were very low, refinancing that debt was relatively cheap. When yields are higher, the new borrowing becomes more expensive. Think about your own mortgage. If you borrowed $500K at 3% and payment looks very different from borrowing the same $500K at 7%. The government has the same basic problem, just on a much bigger scale. And more money going towards interest rate means less flexibility for everything else. That is one reason investors pay attention when government bond yields move sharply higher. Many companies borrow money to grow. They build factories, data center and offices, buying equipment, acquiring other companies, or invest in new technologies. This is especially relevant right now because companies are spending a lot of money building AI infrastructures. For example, Microsoft, Amazon, Google, Meta and others are investing heavily in data centers and computing infrastructures. So when borrowing cost stays low, funding that expansion is easier. When interest rates stay high, the same expansion becomes more expensive, and when existing debt comes due, some companies may have to replace cheap old debt with more expensive new debt. So for a financially strong company with lots of cash and cash flow, that may be manageable. For a company already carrying a lot of debt and not producing much cash, it can become a serious problem. That is why I do not look only at revenue growth when I analyze any stock. I also look at the debt and the cash flow. So what does that mean to a long-term investor? So I do not see rising yield and immediately sell my stocks, and I do not see falling yields and immediately start buying anything. I use bond yield as one piece of information about what is happening in the economy. If yield remains high, I become more careful with highly indebted companies, and I pay more attention to companies whose growth depends heavily on cheap borrowing. Financially strong businesses with healthy cash flow and manageable debt are usually in much better position to handle higher interest rate. Higher yields can also make safer investments like government bonds more attractive, companies with stocks, and that can affect how much investors are willing to pay for stocks. So when bond yields rise, money becomes more expensive. Governments pay more to borrow, companies pay more to borrow, and consumers pay more on mortgage and loans. That can eventually slow spending and put pressure on valuation. So you do not need to become a bond trader to understand this, but if you invest in stocks for the long term, bond yields are something worth watching, because sometimes the bond market can tell us something about the economy before it becomes obvious in the stock market. And that is why I think every long-term investor should at least understand the basics.